Hello and welcome to today's Personal Finance Show here on Dublin City FM with me, Paul Merriman from AskPaul.ie. You are very welcome to today's show. So today's show is going to be a little bit different. I have a guest in studio for the whole show with me, which is unusual, but I'm looking forward to it. I'm going to welcome Bernard Walsh, who is the Head of Investments at AskPaul and Fairstone, to the studio. You're welcome.
Thanks very much, Paul.
Investment markets. Let's bring our listeners up to speed on where the world is today.
Good news, Paul. It has been an absolute bumper year for investing.
Yes.
But there's a big but coming in a minute. But if you look at it, big markets hit an all-time high. So we often talk about the US. The US makes up about 70% of world markets, and all of the big markets, what's called the S&P 500, which is the 500 biggest companies in America, hit an all-time high this week. The NASDAQ, which is all about technology, even better again, and is absolutely flying.
Great, okay. Actually, we had aired during the day. Somebody said the S&P 500 has 503 or 504 stocks now.
Yeah, 500 and speed. There's always somebody coming in, there's always somebody going out, so it's just a little bit more than
the 500 yet.
Than normal. That's there, and that's okay. It rebalances. And the great thing,
I know.
It will always be the biggest companies in America, very strong tech weighting within that. But if you look right across the world, we have European markets up about 18%, US market overall is about 14%, and what's really been quite a stellar one has been emerging markets, so that's places like India and China. Here's a question for you, Paul. What's the best performing market in the world this year?
Hold on, it's Ask Paul, but you don't get to ask. The best performing, I'm going to go emerging markets somewhere.
Yeah.
I would have thought. Yeah. Japan, China?
Close. Yeah, very close. Hong Kong, 36% so far this year, and real mix again, technology a big driver there, but there's a lot of other goods and some luxury providers in there as well. China, you mentioned, is up 17%, the same number as the Irish market. The Irish market is up 17% this year, and you're going to love this. One of the big drivers, bank shares, doing very, very well.
I don't love that.
Yeah,
no, I don't love that.
Yeah. Why are bank shares doing so well? Well, they're doing so well because
they're robbing consumers with deposit money. Let's just say it out loud.
Far be it from me to say that. But if you look at the difference between the ECB rate, which is now 2%, and typically what they pay on deposits is about 0.7 if you're doing really, really well, or about 0.0007 for most people. That's a nice bit of profit, and that's helping to drive. There are others doing well too, Ryanair, others like that, again, going along. But
pun intended.
Yeah, exactly. So there's some of the big ones. What about the yellow shiny stuff? Up 39% here today. Gold just doing extremely well. And then on the other side, oil, that is something that's very relevant to all of us. Down about 10%. You don't quite see it on the petrol pumps, do you?
No, you don't. They don't pass it on like Bank of Ireland, AIB and PTSB.
Yeah, absolutely. What's been a big driver this week? Interest rates. Yeah. So interest rates have been cut in the United States again. Interesting, there's meant to be independence of the central bank. They decide interest rates. The guy called Jay Powell, he's due to finish up in his office pretty soon. He's come under huge pressure from the Donald.
Oh, he has.
Cut interest rates. So he's finally this week, he's cut interest rates by 0.25%. The Donald was looking for an awful lot more, but he's been busy otherwise in the carriage with the King of England. And so but we saw the first cut. So why do we care about US interest rates? I mean, do they affect us every day? They sure do, because 70% of the world stock markets are housed out of the United States. Cutting interest rates means more profitability for US companies, encourages people to borrow, encourages people to spend.
Well, of course, people to spend because people have money in their back pocket. We've seen the reverse of that when interest rates went up, especially in Ireland, when people stopped spending. I think it was interesting with Powell and Trump that he only cut by 0.25%, and I think what might happen when he exits, you might see more of these cuts, or at least one more cut. I think Powell's been right not to cut though, because I think the fear around inflation and what the impact of the Trump tariffs haven't really washed through yet.
No.
So it'd be interesting to see what happens when he goes. But it's great to see a bumper year for Marcus. But this is really important for listeners, in my opinion, Bernard, is when Liberation Day happened there in the year, a lot of people would have panicked and a lot of people would have moved their positions out of the market. And we always talk about this with our clients. I think our role as financial planners is there from a kind of behavioural finance piece and coaching your clients to what to do when things go wrong. But if anyone hadn't moved out of the markets a day or two after Trump put those tariffs out, they just would have missed this bounce that's happened since. So it just goes to show, staying invested consistently and not worrying about those market turbulent periods. And if you look at what's interesting, I might get your opinion on this, I know we're on air doing it, but if you look at COVID-19 only was, I think it was a 4 or 5 month lag before the market bounced back and it went on a massive rally. And you're like, going back when I started my career 20 years ago, if you thought of something like COVID, I would have thought that it would have been worse than the financial crash, typically speaking, because the whole world was closed down. If you look at what Liberation Day was Trump with the tariffs and how the markets reacted, and I can't help think that it's technology and it's the amount of people investing, because everyone keeps talking about the concentration in the markets and how the Magnificent Seven are driving the S&P, but I think it's purely how accessible investing has become around the world. Like when I started 20 years ago, it was a different world when it came to investing. And Irish people in particular didn't know much about investing. But even on AskPaul, on our Instagram page, we're getting kids like 16, 18 reaching out saying, how do I get invested? How do I start? They all know about the S&P 500 from like Tony Robbins talking about it, Gary Vee talking about it, like just so many content creators in the States and the UK talking about it. So I'm not saying I can't see this ever coming to an end or a big correction at some stage, but everything that looked like should have been a big correction gets sorted out very quickly because, and I don't know whether it's the bots, I'm not sure whether it's the quantitative, I'm not sure whether it's the sheer mass amount of people that are just investing for the first time and keep driving these valuations.
Yeah, look, there's a lot of interesting things happening. You do see them fall and you do see the bounce back. But the people who miss out, they miss out. You know, people who jump out of the markets. So how do you time it? It's very, very difficult. So let me give you an example. So I saw this data carried out about soccer penalties. So they took all the data from the Bundesliga, La Liga, the Premiership, all the European markets. So goalkeeper facing penalty can do one of three things. They can dive left, they can dive right, or they can make themselves big and just stay in the middle. So which do you think is the most successful strategy?
I'm going to say stay in the middle and make yourself bigger. Yeah,
that is the one.
Because I presume it's because the penalty taker might actually miss the target rather than actually score. Is it?
And it is your best chance of success. And the same thing applies to investing. Your best thing to do is just stay there. You know, there used to be a phrase used to be told, don't just stand there, do something. The opposite applies to investing. Don't just do something, stand there. Because that's what the market does.
Just stay invested.
Just stay invested. It has a really, really powerful influence. Go back to what you said about Liberation Day. That caused a very sharp drop. And then we've seen a we've seen a strong recovery. The one thing that we have seen though is the dollar has remained weak. So the dollar got weaker around that time. So while we've had bumper returns in markets, just remember, because if the dollar weakens, when you translate it back into euro terms, it's not as good. So your listeners may not have benefited to the full extent of that. And when the dollar ultimately, if it does start to pick up, you'll actually see an increased benefit from that as well.
But I think that dollar weakening and where you mentioned the gold rising so much, that's a real sign of people not maybe having as much confidence in the US dollar while Trump is there, but yet the stock market looks like it has the confidence, as in the companies have the confidence, but the dollar definitely has lost confidence in my opinion. It's also interesting when you look at how much gold China has. So, you know, if you were looking, I think it's every 100 years you see this kind of event of, you know, the change of world currency, the change of world leaders. It's been 80 years since the kind of dollar has been in, and I can't help but think that over the next couple of decades, if history repeats itself, which it tends to do, you might just see something happen there with the dollar, gold, the yen. It's just going to be very interesting over the next couple of decades.
It is, but a lot of it is about the interest rates. You know, we said US cut interest rates. But remember, a lot of people think about looking at the news, what's happened. Markets are forward looking. So you know the phrase ready, aim, fire? No. When it comes to investing, it's ready, fire, aim. The markets have moved long before anybody listening to this call can react to them. They're thinking ahead. They're always looking for early signals. So it's not just that the US cut interest rates last week. It's that they're expecting 2 more cuts between here and the end of the year.
And that's what the market's pricing in now. It's those 2 cuts. Quickly then, you mentioned ECB very briefly. We've got into the US interest rates. We've held the rate here. I was saying to listeners for the last 6 months, I can't see many more cuts. I thought the last cut was going to be it. And I think the ECB is way more conservative. The ECB doesn't have the pressure that they have in the Fed in relation to, stimulating the economy. So what's your thoughts there? I mean, I can't see a cut coming. I presume you can't either.
Not really. I mean, what was ECB worried about is price stability. So that's inflation. And inflation, we all might think that prices are rising. They have eased off a little bit of late. So at the moment, inflation is about 2%, and that's what they want. So anything in around 2% is fine. There's no sign of an interest rate cut. Economic growth is okay. The problem child of Europe is France. And we've got more protests in France. They've lost yet another government.
Yes.
And France is a big part of the European economy. So let's see how that plays out over the next period of time.
I'm sure the listeners are going, how did Paul not bite about the Bank of Ireland being PTSB profits being up because they haven't passed the ECB on? So guys, look, from a list, I say this every week, I'm sure everyone's sick and tired of this. Bernard's given a classic example there. The Irish stock market is up 17%. Big drivers are the 3 banks, and most of the profits are coming from your money. So if you have money in savings, in a current account, overnight, a deposit account, etc., the bank can take that money, give it to the European Central Bank, and then the European Central Bank will give them, say, 2%, and they're not passing to you. They're maybe giving you 0.5, 0.7, I think, is Bank of Ireland's average over the last 12 months. That other 1.3 is their profit. You can simply move your money to a European bank that's giving you 2 or 2.5%. I'm always like to say, head over to AskPaul.ie, look at the savings tab, get into Raisin.ie, so RAISIN, Raisin.ie, or indeed through the Ask Paul website. And on Raisin, you're going to get access to all those European banks. I think there's 29 or 30 banks there. And this is a big thing because, and someone said this to me recently, it's only 1%. It's not only 1%, it's the principle of your money devaluing. Because you've mentioned inflation is 2, and you're only getting 0.7 off the bank. Your money's devalued by 1.3, and if you do that for 10 years, it's 13%. So you just really have to look after your money. I don't care if it's €1,000, 10,000, 100 grand, a million. Get the money out of the Irish banks and get it into your own account in a European bank, making interest for you. So we did bite eventually. You didn't get away with it. Listeners, this is a big one. So you might have seen my Instagram stories during the week. We had a conference in the Intercontinental Hotel in Dublin this week, where we launched new funds to the Irish marketplace. So we at Fairstone and Ask Paul now have our own funds. There are 3 funds particularly. We've got the Fairstone 50, Fairstone 75 and Fairstone 100. So Bernard, we might just bring clients through what they are, why they are, who we've partnered with, and why we're so ridiculously excited about it.
Yeah. Well, let's look at what we're trying to solve here. What we said was, we want to get you a better return on your money. We've mentioned inflation a few times. It eats in, we call it the silent thief. Sneaks into your house, steals money from your wallet or your purse. I call that my children, but anyway, it's what happens in the markets every day of the week, unbeknownst to you. So we want to get your money growing, better than you're getting on deposit, better than inflation. And we said before the break we said Hong Kong was flying, China was doing well, Ireland. So where's the best place to put your money now? And the answer we would always suggest is, it's about having diversification. Don't put all your eggs in one basket, having the right mix. And different people want a different journey for their money. So when we meet people and ask Paul, and how many thousands of people have been through this journey with us?
It's over 25,000. Actually, as a group at Fairstone, we learned yesterday it's over 37,000 clients now in Ireland, which is phenomenal.
So one size doesn't fit all 37,000.
No.
So what we try to do is try and say, can we come up with an investment solution, aims to deliver that growth, aims to do it with diversification, but we can section it off into the person who wants maybe the smoother journey with less ups and downs, and to those that want quite comfortable with the ups and downs of markets, but wants that higher level of growth. And there's a great phrase that comes from one of the pioneers of investing, a guy called Jack Bogle, who has this phrase: instead of trying to find the needle in the haystack,
just buy the haystack.
Buy the haystack. And that's what he said, and that is what we're trying to do here. So what we've done is we've said, what is the right mix of shares, of bonds, of property, of cash? What's the right mix on an ongoing basis? And we said, let's partner with the biggest in the world at doing this. So we have our own Fairstone private wealth team in the UK, and they get research from the biggest in the world. They're called JP Morgan Asset Management, and they've been around for a very long time.
Is it 1857 or 1867?
Yeah.
They're knocking around since.
And the fact they've been around that long, through all of the crises, through the Wall Street crash in 1929, through the dot-com bubble burst, and they're still
World Wars, everything.
You name it.
Yeah.
They've been through the lot. And why have they been around is because they have boots on the ground all over the world, understanding what's going on. They meet all of the biggest companies in the world, and they know their plans before any of us do. They know what's going on. They spend €500 million a year on research.
That's staggering. I remember seeing that at our conference so JP Morgan, for listeners, spoke at our conference on Thursday this week, and I remember seeing that slide, and I was absolutely blown away. $500 million just in research is phenomenal. So let's just bring listeners through what JP Morgan do in the fund, because they don't actually manage it, but they look at what's called the asset allocation of basically where we should be placing our clients' money, whether in the fund it's going to be X amount in equities, X amount in bonds, and where those different geographical regions are. That's their job.
That's their job, and and that's what dictates an awful lot what returns people get over time. Then the next layer below that is to identify who will actually carry out the allocation into the markets. And then we use some of the very big players all around the world. So one of them is called Vanguard. I mentioned Jack Bogle founded the company. One of the things I love about Vanguard is it has this constant focus on delivering for clients. That lies at the heart. When we walked into their big office in London, there's a big red V, and their mission on the wall is all about supporting their clients and keeping their interests at heart. The company is owned by its US clients.
Yeah. It's a mutual company. It's not shareholders they're trying to generate profits for. Yeah, it's an amazing story. We might try and get Roy or one of the team in from Vanguard on for our listeners over the next couple of weeks to get really into the Vanguard story. But Vanguard, I think, is 11 trillion they manage worldwide. And why we've gone to Vanguard, Vanguard make up over 50% of the fund predominantly. We have got Fidelity in there and BlackRock, and again some of the biggest names. But I think everyone is familiar with Vanguard, and I think there hasn't been enough access to Vanguard funds in Ireland. And because they're so big, they're so good, and they also try to deliver so much value for clients. Like, they really bring in that low-cost piece. But if listeners are thinking, what's this, why is it new, and especially if any listeners that are clients of ours, in Ireland, you typically have a range of life assurance companies and maybe stockbrokers, and the life assurance companies will, manufacture their own products. If you look at the likes of Irish Life, they manufacture products, but they also manufacture products to push them out through the bank assurance network, with the likes of PTSB, for argument's sake, and that's obviously down to the consumer through brokers like us. We've been a quite good supporter of Zurich, and they had some phenomenal funds. I'm still invested in those funds, but with a relationship, and we were acquired by Fairstone 3 years ago. Fairstone in the UK, and don't forget the UK have 66 million people. Here in Ireland, we are so small of a nation that these big Vanguards and these big players don't necessarily want to kind of come, not that they want to come into the market, but they haven't spent a lot of time trying to penetrate our retail clients. That's what we're here to do. So we're a relationship with Fairstone having 20 billion of assets in the UK. They already had a relationship with JP Morgan and with Vanguard. And that was predominantly why, when we sold the business, we sold to Fairstone, because we wanted to bring best in class into Ireland. And it genuinely is the proudest day of my career. I'm in the industry over 20 years. On Thursday was the proudest day ever, because bringing these funds and bringing these names to Irish consumers in a way that's never been done before is absolutely class. It's so good. But yeah, the three funds, we've got a 70, 50, 75 and 100. Yeah. You mentioned the different kind of risk profile there. Someone going to 50 will typically have 50% in equities, 50% in bonds and cash, in kind of medium risk maybe. Yeah. And as you go up to 75, even 75% of equities, and obviously the Fairstone 100 would have 100% in equities. I would kind of break it down that if I was in my 20s and 30s and maybe 40s in a pension and I wasn't accessing it for 25 years, I'd be in the Fairstone 100. Yeah. If I was somebody that was looking to beat inflation and wanting the money back in 5 to 7 years, I was a little bit conservative, I'd go 50.
Yeah.
And I was looking at maybe 7 to 10 years, and I had a good understanding of investments, and I don't mind the ups and downs. And I can also invest maybe on a monthly basis as well with a lump sum, because you're getting the movement up and down euro cost averaging. I go for the 75. And that's a really good way of explaining to listeners maybe which one you should be in.
Yeah. And the good news is we take you through a process. Mm-hmm. We ask you a number of questions that helps us to understand you. And again, this is about taking time. This is not robotic. We spend time with you to understand what you want. And people are different. And this is back to one size doesn't fit all. You know, it is to find what's right for you and what are you comfortable with. We don't want you lying awake worrying about this. It's about making sure that you have that comfort. And then you leave it to us.
Yeah.
And then allow it to do what it's meant to do. So it's like planting the seeds in the ground. Put them there, leave them there, and then let us do what we're meant to do.
And I think that's a good thing, what we do with the Ask Paul financial planning consultations, for argument's sake. If a client does come in for the pension or the investment piece, let's say they have a figure to invest, we'll always bring them through the financial plan piece to make sure everything else is covered. So making sure they don't have too much high debt that they're paying too much interest on, and making sure they have their emergency fund in place, making sure they have their short-term cash requirements. So it's like a safety net before you invest. Where sometimes you find that people can get advice, and I think is wrong advice from other people, where they're saying, I have, say, 100,000, invest 100,000. That you can't invest 100,000 without knowing your client and knowing everything about them, in my opinion. Yeah. So that's where the financial planning consultations always work well for me, whether it's a few £100 a month you have, or whether it's $1 million. And we've had clients come through here that sold businesses and have had inheritance of, substantial wealth. They still just start with a financial plan.
Yeah.
Because they have to. You can't just jump into the markets, and you can't just jump into trying to make returns without knowing what your current, you mentioned this before, planning. It just has to start with a plan. Where you are today, where you're going to get to, and is there anything that needs emergency help now before you start chasing returns?
If you think about when you get into your car and you want to go to wherever, go down to Galway today or go somewhere, what do? You put on Google Maps. Mm-hmm. Now, that tells you how to get there.
Or you put on the Ask Paul Personal Finance Show on Spotify, just to say that is there for you as well.
And Google Maps, this is the financial equivalent of Google Maps. It tells you your journey.
Yeah.
It should tell you how long it should take you to get there. And again, there will be ups and downs. There could be traffic along the way. There could be whatever.
Few diversions.
But you have a good idea where you're trying to get to, and where you're trying to get to is your goal and what we're trying to achieve for you. The journey then is your financial plan, and that's what we're trying to achieve here. And some people say to me about risk. We manage risk two ways. Number one, diversify. Remember, within these three funds, they each have about 55,000 assets.
Oh, and this is the big one for me, because we've used funds in Ireland for years, and because they were owned to what we had available to us. So we look at one of the funds in particular I'm invested in, the Zora Dynamic Fund. That fund has been around for 32 years, phenomenal returns, nothing wrong with the fund. However, I think the world is a different place. And I went into that fund 5 years ago. It just the 5th year anniversary came in May this year, I think. So I've always said you keep your strategy for 5 years. And regardless of how good these funds are, if I have a client that's in the Dynamic Fund today and he's only in, say, or she's only in a year or two, we will still recommend to stay the course of that investment decision. And at the end of it, then you make your decision. But if you look at those funds, I think there's 700 holdings in the Dynamic Fund. And that was a really well diversified fund. It's been a good fund in Ireland. And now you're saying 50,000. Like, the diversification that we can get through Vanguard and through the relationships that Fairstone in the UK have given us access to is just phenomenal for Irish retail investors, I feel. And the expertise that come with it is off the charts.
But it's also by, trying to find the next superstar company. So what are the kind of companies that have been doing incredibly well? Well, it's companies like Nvidia.
Actually, this is a big one. Let's talk about this with the S&P 500. So Vanguard presented, we at our conference, we had 200 people in the room, and they were all our own staff and our own partners from around the country. And I remember Vanguard going through the S&P 500. And I think it's 63%. So the S&P 500 in 2024 to 25% for return. Yeah. 60+% of those companies were made losses.
69% lost money.
69% lost money. Yeah. So when people are saying, I'm going to go for the S&P 500 because the best 500 companies in the world, nearly 70% of those 500 companies made a negative impact to the S&P 500.
Yeah.
But then you have a stock like Nvidia that did what, 1,700%, and that drags that loss of the 69 through. So that's back to that buying the haystack and not looking for the needle.
Yeah.
So even though you own 70 companies that have performed really crap, you end up with, you know, the superstars out there.
Yeah.
The Nvidia, you know, the Metas, the Googles, the Microsofts, those type of firms.
Yeah. And you're also finding them early enough too, as they're developing up through the S&P index, and you know, as the companies grow and they'll start to make up a bigger and bigger percentage of it overall.
But it's constantly changing.
Yeah. And also, but because we also have some property, we have some cash, we also have some government bonds, you really have that wider mix as well. And you know, there are different drivers of returns in some of these areas. So what it means is, rather than you as an individual having to go out and try and find all of these different assets, it's all done for you. And you're getting the benefit. And that's why we call them market funds. You get the return of the market.
The return of the market. For listeners that are interested, over to AskPaul.ie, there's going to be a lot of content, obviously, on the AskPaul page in relation to the Fairstone funds, the three range of funds. If you are interested, book in for investment consultation via AskPaul.ie, or reach out to us by DM on Instagram, which is the AskPaul.ie page. We can bring you through some of the options. Guys, that's it for today's show. Hope everybody enjoyed the session. If you want, you can go back over to Spotify, search for Ask Paul on Dublin City FM. I hope you all have a great day. Bernard, thanks a million for joining me in the studio. Much appreciated. I really enjoyed that chat.